Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. Today, we're going to dive into a couple of reports that are all about startups in the regular world. There's mergers and acquisitions as venture capital is starting to pile up, maybe due to a lack of investment opportunities. There's non-traditional venture capitalists that are continuing trying to find billion-dollar companies called unicorns, and yet mergers and acquisitions plunged to a 3-year low. Also going to give a recap about how to assess a cannabis deal without traditional metrics. Also going to give a recap about the current cannabis capital raises that are surging year over year, but on smaller ticket rounds, as well as briefly discuss that there's more to exiting a cannabis business than simply deciding whether to sell or go public. So the mergers and acquisitions spree isn't just in the cannabis industry. We're starting to see a lot of companies gobble each other up. And the common denominator is that they're all trying to pursue higher revenues, higher market caps, more distribution or access, more sales, more products, and just trying to appease shareholders in some cases. The traditional venture capital playbook has shifted over the last decade. The article goes on to say, quote, general partners are sitting on stacks of capital, enabling young companies to raise bigger rounds and stay private for longer. These pervasive trends have contributed to a fundamental shift in what it means to be a venture capital-backed company. Today, more and more young companies find themselves in a position to raise funds, even when the balance sheet is strong. Instead of spending raised capital on organic growth, some venture capital-backed companies are taking pages out of corporate playbooks and deploying a buy and build strategy to supplement their own growth. As with most deal strategies, this type of approach has implications for the risk and return profile of the investment. You can kind of see that with WeWork right now. They were a $47 billion pre-IPO market cap, and now maybe it's really $3 billion as people have pulled out of properties in London. SoftBank is out. And that IPO has been delisted. They're not going to go public. The CEO had to resign or at least step down. And that's just one company, one example. But how much do venture capitalists actually have in a company's strategic decision making? Quote, not as much as you might think. Venture capitalists have minority stake in their companies, and although they often sit on the board of their portfolio companies, they don't always have as much sway in specific strategy decisions like an M&A deal. Additionally, with the founder-friendly approach gaining popularity, founders are able to exercise a broader reach with respect to deal making. As the number of M&A deals with participation from startups continues to rise, here's a look at some of the most notable deals in the first half of 2019. They talk about Axios, which is a news media startup acquired by Sports Internet, a daily sports newsletter based in San Francisco. And then The Skim, an online newsletter catered to millennial women acquired by Purple Politics, a text messaging platform for political news that focuses on encouraging debates and conversations. Number 3 is Epic Games, a developer of computer games such as Fortnite. They acquired 4 companies so far in 2019, from live streaming on mobile devices to creating digital characters. The series of acquisitions hopefully will boost the presence in the industry. Number 4 is Robinhood, which is a platform designed to help people learn how to invest in the stock market. They acquired Market Snacks, a daily financial newsletter, for an undisclosed amount. Number 5 is Sophie. Sophie aims to arm its users with the tools to achieve financial independence. They acquired Lantern Credit, which is a platform designed to solve systematic inefficiencies in the consumer credit market. Definitely something that the cannabis industry needs, like a lending tree for cannabis to kind of aggregate people that are looking for funds, as well as lenders of all types, and kind of create that platform. Airbnb obviously is connecting travelers and hosts. They acquired 5 different companies in the first half of this year, from property management technology to hospitality platforms. The acquisitions will hopefully broaden its presence in the industry. I recently spoke on a panel for the Chartered Alternative Investment Advisors Seattle chapter for non-traditional venture capital, looking for the next best thing, which they are hoping is hemp and cannabis. So this pitch book article kind of goes into non-traditional venture capital, continue to trying to find that unicorn, that billion-dollar private company. Last year, larger funds and bigger deals had an increased appetite for alternative assets, fueled by a record-breaking total venture capital deal valued at $131 billion. According to this article, it goes on to say, quote, last year saw a dramatic peak of unicorn deals with non-traditional venture capital participation as the group contributed $43.5 billion across just 100 transactions. That activity continues today. So far in 2019, they participated in 53 unicorn financings totaling $17.7 billion. So what are non-traditional and tourist investors? We're looking at things from a higher level. Non-traditional venture capitalists and tourist investors include essentially everyone outside of traditional venture firms, such as corporations, LPs, private equity firms, sovereign wealth funds, hedge funds, investment banks, etc. The group is proliferating quickly as more new participants become involved in venture capital. As investors from around the world are increasingly active in venture, they're feeling its ongoing globalization and the unicorn phenomenon. Last year, 12 unicorn-related deals with only foreign investor participation closed, worth a total of $4.8 billion. So far in 2019, even more capital has been introduced by this group, tallying over $6 billion in unicorn funding. End quote. Now, it's my opinion that people are looking for higher yields. Pension funds, for example, have 7% just to break even. They're looking for 15%, and that's crazy. Even Bernie Madoff, the Ponzi scheme guy, was only offering 12%. So a lot of these people are going to be looking for higher yields, higher opportunity, more risk, that whether that's debt or cannabis. It's a little risky when people are out there looking for higher yields, and it's no different from cannabis companies or unicorn hunters or even pension plans like Illinois teacher and police unions, or CalPERS, that's the California Teachers Retirement Plan. They're all looking for higher yields, and eventually they're going to be looking to the cannabis industry that has an inverse relationship in times of economic recession, depression. Look up Sin stocks. We've done a couple of reports on that as well. They always do better by comparison. Though many factors have contributed to venture capital's recent breakout year, part of this rise is due to the non-traditional investors' increasing willingness to spend more in the hopes of snagging a unicorn. These atypical investors have played a key role in the ongoing evolution of the unicorn phenomenon and the venture capital landscape, and you can expect this to continue for the near future. End quote. I would also extend that to the cannabis industry for all of the same reasons. Publicly traded companies are doing similar things with stock buybacks to increase their earnings per share. By decreasing the number of shares outstanding, it increases their price and therefore gives all those executives a bonus for the year. And then the shareholders think, oh, yeah, that's great. Except when you invested in a tech company like Amazon, you probably didn't invest in the company so that they could then turn around and buy their stock back. You invested for future products, future sales, and not stock buybacks. That's not something that Steve Jobs probably would have wanted to do to the extent that Apple has done that. They would have produced more products, and instead they just come out with more cameras. Like, that's going to make sales. It's just becoming obsolete with these guys not reinvesting in future products. And tech companies, if that would have happened 10 years ago, they would have been shorted, and now it's just kind of normal, but it's not. People just don't really understand that it's an accounting gimmick, with the exception of a good value price. Right now, it's the highest stock market has ever been. So the stock prices aren't at a valued rate. It's at a premium. So it doesn't really make sense, in my opinion, for these companies to be buying their stocks back. We've seen a lot of cannabis companies go public, either through an IPO process or a reverse takeover. And there's a report from Zero Hedge about an IPO crash, kind of indicating that it may lead to a global IPO correction. So according to this graph, the median 2019 IPO is sharply underperformed relative to history. So as the global IPO bubble implodes, there's a new report from Reuters that warns how global mergers and acquisitions are also plunging, a sign that economic uncertainty surrounding the trade war has frightened capital markets. As corporate sentiment deteriorates around the world, many believe a global trade recession could arrive as early as 2020, which has sparked a massive push into money markets, precious metals, and government bonds in the last 6 to 8 months. The M&A volumes have dissipated because there's concerns that risk may be rising in several spots in markets and elsewhere. One of the largest M&A deals that went bust this quarter was Marlboro maker Philip Morris trying to merge with Altria Group. It would have created a market value of $200 billion. The deal was scrapped when the government officials opened investigations into Altria's Juul e-cigarettes for the possibility of triggering a dozen or so vaping-related deaths. Warning capital market sentiment because of trade wars and recession threats could lead to more management teams pulling deals. It certainly seems that the window for IPOs and M&As are closing as economic turmoil could flare up in 2020. And a slowdown in the mergers and acquisitions is an ominous sign that Wall Street banks will see a declining revenue in the quarters ahead. I believe that there's going to be a lot of movement as people transition their investment vehicles from riskier assets to cannabis that's more speculative. The greed and the speculation that we're seeing from individuals to hedge funds looking for that next unicorn is an indicator that during the next economic recession, we'll see a massive shift into the cannabis space as sin stocks will take off. There's always that inverse relationship that we've seen time and time again as defensive cannabis, alcohol, tobacco stocks go up in times of a recession or depression. So I have no doubt that in time, we're going to see all of this speculation dive into the cannabis space, maybe go parabolic, but nonetheless, we'll see a massive wave in there. So you can ride that wave, but just know that it's not going to be permanent. Just understand what goes up must come down. There'll be some equilibrium there if you want to play it. Yahoo Finance picked up an article from Benzinga about cannabis capital raises surging year over year on small ticket rounds. So the investment and merger and acquisition activity in the cannabis industries from September 16th through the 20th had 14 capital raises that closed totaling just under 81 million and outpacing the 9 deals totaling just under 76 million from the same week last year. Although more overall capital was raised year over year, the average size deal declined due to a greater number of small transactions. Of the 14 raises, half use equity structures and half use debt. While in previous weeks, they saw large debt raises by cultivation and retail operators. And in this week, the largest raises were closed by digital media brands expanding into the branded CPG category, as well as cannabis testing laboratories looking to expand services in the face of the recent vaporization scare. While they continue to see raises close for both touching the plant and ancillary businesses, this week saw greater activity on touching the plant side, predominantly because of several small raises in that segment. California may be bending that trend as a lot of people are kind of coming on board with once the laws settle out there. The fact that there's half debt and half equity is interesting. That tells me that if people are utilizing debt, that it's more of a sound fundamental source with collateral that's backed, is more normalized. Where normally you just see equity or even a personal note, like a convertible note, which is a personal note that converts to equity, but we're seeing debt. So that tells me that there's a lot of confidence as well as speculation and a lot more normalization. I believe that there's going to be a lot of equity being poured in from traditional spaces as people are looking for, that next unicorn out in Silicon Valley. They'll be looking for cannabis tech and other companies, vertically integrated opportunities, international opportunities. There were also a few mergers and acquisitions. There were 4 last week, slightly below the 6 that closed in the same week in the prior year. All of the closed transactions involved private companies as the targets, and public companies continue to see the acquisitions of non-cannabis related businesses by those in the cannabis sector, and expect to see more acquisitions like this in the cannabis companies look to capture valuable assets, technologies, or synergies from outside of the industry. U.S. state operators in limited license states such as Pennsylvania continue to attract acquire interest due to their favorable supply-demand market balance, larger markets with fewer competitors. So I'm expecting to see a lot more activity. We see this MJ Business Daily article that there's a lot more to exiting a cannabis company than simply deciding whether or not to sell or go public. Scott Greiper of Viridian Capital Advisors said, quote, "There's an exit opportunity for private companies and the exit is today. There are buyers in the hall." The article goes on to say that the would-be buyers are not interested in purchasing a cannabis firm unless it's well run. And some key points to consider for entrepreneurs wanting to weigh an exit strategy: you need to have a defined exit strategy. If you think you're going to have a legacy, think 7-Eleven versus Larry's Handy Mart on the retail side. You probably want to exit and then come back in a niche way. First mover advantages. Second on the list is decide whether it's better to be acquired or to go public. It's not cheap to go public, probably $800,000 for a reverse takeover that's buying a shell company versus about $4.2 million to actually go public to get an underwriter, a bank to sponsor your big board exchange on the Canadian Stock Exchange, for example. So probably look at being acquired by somebody else with actual synergy so you can be vertically integrated to look at merging with an existing publicly traded company. Number three, factor in the role of a large mainstream retail company. You want to be able to control the price along the way. There's a lot of advantages in Colorado and California being vertically integrated where the retail shops own the producer and processor along the way. So they're selling their own product essentially. Washington doesn't have that. And it's one of the most competitive markets probably in all of North America since retail shops cannot own or operate a producer processor. Number fourth on the list is get your firm's financial house in order. A CFO or director of finance, M&A analyst, all those things are incredibly important in order to help you stay compliant. It's very, very difficult. It's a lot of hand holding if you don't know what you're doing, which can just derail you from business as usual. You want to be able to operate, and getting your house in financial order is critical. And the last on the list is be realistic about your goals. Having a set expectation, being able to communicate that clearly is essential. But how do you assess a deal without traditional metrics? Well, that's a good question. This MJ Business article asks just that. Cannabis companies are issuing debt and equity warrants for acquisitions at a rapid pace right now, moves that require answers to key questions for keen investors. The article goes in to ask, quote, did the deals provide management an opportunity to create or destroy shareholder value? Or are the deals accretive or dilutive to your ownership stake? Those questions can be difficult to answer when there are scant traditional financial metric details such as EBITDA, EPS, or free cash flow to analyze. But there are two quick methods to get your arms around the deal economics with just some basic financial information like a return on capital or EBITDA per share. Valuating cannabis companies has always been a difficult task, although it's getting easier because there are more examples to take. One of the easiest ways is a competitive analysis using EBITDA. That's the earnings before interest, taxes, depreciation, and amortization. If there's a competitive analysis, then you can just take that and use that as a standard, similar to comparative market analysis on a house, for example. In the traditional world, they also use a discounted cash flow, looking at if it's accretive or dilutive. That means if there's an advantage, if there's actual synergies, if it makes financial sense, then it's going to be accretive. They're going to look at earnings per share from both companies to make sure that at the post pro forma after they've merged, that it's accretive or that it's synergistic, that it's financially stable, that it's going to be a going concern, that it's going to stay in business. Public comps are also incredibly nice and convenient if you have acquisition comps or transaction analysis. That can be very, very helpful. What we don't necessarily see yet so much is a leverage buyout. Someone would want to take a look at a leverage buyout using debt to purchase another company if they has low leverage, high free cash flow or EBITDA, and low price to earnings. That would make that very accretive and a great strategy. We see that in the regular world, not so much in cannabis yet, but I would imagine that that's probably going to change very soon. And so there's kind of four different ways to have synergy. You can have an increase in revenue. You can have an increase in production, which would help with operations, increase in market share. That's going to help you with costs and economies of scale. And you have a lower financial risk and borrowing cost, which is going to help your financial statements. So there's a lot of strategies, whether you're going to go public or find a shell company to have a reverse takeover or just merge with a bunch of other companies until you become so strategically palpable that other publicly traded companies want to buy you. Whatever the strategy is, you need to have an exit strategy. Believing that you're going to have a legacy, I just don't think is going to help you long term. Things move too quick. Utilize that first mover advantage. Come back to the Talking Hedge. Leave your comments down below. Get involved. With that, we're going to roll this one up. I'm Josh Kincaid. Don't forget to like, share, and subscribe, or don't. And I'm out.